Hello, everyone, and thank you for joining us today. We're excited to kick things off and learn more about a timely topic for retailers, especially at this time of year, financial numbers. Now, before I introduce our guest panelists, I did want to run through a couple of housekeeping items on the call today. First and foremost, we are recording this, so we understand the life of a retailer can be a busy one, and we're going to send a recording after we're done, and that way you can review this on your own schedule with your team on your own time. Secondly, this is a live session. So right down there at the bottom, we definitely encourage you to ask questions. Just use the Q&A button there at the bottom there, and we'll run a couple of questions at the end. We have some time at the end that we can fire off some questions to our panelists. Finally, a quick mention about us here at Management One. If you're not already familiar with our company, here at M1, our main purpose is to provide financial security for our people, our clients, and our affiliates. And we do this with a focus on merchandise intelligence and education, like this session here, specifically for independent retailers like you. And collaboration here is one of our most cherished core values at M1. So I am pleased to introduce our panelists, William Lieberman and Lisa Shaari, from the CEO's right hand to deliver the presentation. Thank you, guys.
Thank you, Nico. Glad to be here and glad to be in front of all the M1 members on the call. It's always exciting to be able to spread the good word about finance and help you figure out how to navigate the world of finance and accounting. So Lisa and
Love
I
it.
are going to step through a number of concepts. The slides will be available afterwards, so don't worry about taking everything down. We have been doing this a long time. Lisa specifically has a lot of retail experience. I have a lot of finance experience as well. So we're here to help decode, if you will, what you need to understand for your financial statements. So what do you need to look at? What do you need to think about? What should you care about when your bookkeeper hands you your financial statements at the end of the month, end of the quarter, end of the year? So the goal today is for you to have a better facility for looking at your financial statements, making sure you use that data, that information from your financials to make better decisions. At the end of the day, that's what finance and accounting is all about, is providing you, the business owner, with information to make better decisions. We are going to, look through the income statement and balance sheet at a high level and talk about red flags that you need to be on the lookout when you're looking through your financials so that you understand, hey, I need to dig more into this issue and find the root cause, and give you a little bit more confidence when you're speaking to others about your finances and accounting. We have a bunch of content. We're going to leave room at the end for questions, but feel free to put them in the chat. Nico is going to sort of monitor the chat, so
Absolutely.
keep track of any of your questions along the way, and we'll get to them at the end. Uh, as Nico mentioned, we come from the CEO's right hand. I founded the company a little bit more than 10 years ago. I've built and sold a bunch of different businesses along the way. And Lisa, as I mentioned, has many, many years as a CFO and has specialized in retail business owners and helping business owners in the retail space. So we've been there, we've done that, we've sat in your seat. So we know the issues that you're going through. We've seen it many, many times. And believe me, if you think you have it, you're in really bad shape. We have seen worse, guaranteed. So don't feel free or don't feel afraid to ask questions and raise your hand along the way, and we will try to get them either during or towards the end of the presentation. So one of the things, I think we have a poll, right, Nico?
We do, yeah. So I mentioned at the beginning, this is an interactive session. We've got a poll that we're going to launch right here. Basically, this question that William has up on the screen. Just think in the top of your mind. I'll go ahead and launch this. On a scale of 1 to 10, where do you think you are with the various questions up here?
So
And we'll
in
let
terms of
that.
your financial confidence, how
Mhm.
confident are you in your ability to understand your income statement, your balance sheet? Do you know if your business is fiscally sound or not? And could you explain your financials to a banker, to an investor? Let's say you wanted to go get a line of credit And the banker said, well, tell me about your gross margins, or tell me about, unit contribution margin, four wall margin. All those types of things are really important to understanding and having a conversation with people that are interested in your finances. Sometimes it could just be another member of your management team. So those are the types of things where you need to have a facility to have that conversation. So we'll give everyone
Yeah,
a few more seconds,
we
and
have
then
folks
we'll.
actively clicking here. Yeah, I'll shut it down in about 5 seconds and we'll see where folks are at. And
It looks like a good spread. All
all
right.
right, there we go. Yeah, definitely a good spread across the board.
Yeah, looks like an average about the average. It looks like about five-ish. So that's what we would expect, right? So let's jump right in and go through first and foremost why you should care. When does this come up? And as I mentioned, when you're talking to a lender, a bank needs a line of credit, or you need a line of credit from a bank, and you need to understand here's my financial information. Here's what I'm telling the banker. Does this make sense? Right? Am I giving them the right information? Do I have enough information? Is it detailed enough? And having that financial literacy helps you talk with your banker to present the story, right? So lots of times, look, it's COVID, things happen, there's an asterisk, everybody gets that. But what did you do to, recover from COVID, as an example? What are you doing in terms of supply chain? What are you doing in terms of tariffs? So all those types of things impact your financial results. They're going to want to see that financial information, but they want to hear the story that goes with it. As you grow your business, you need to understand what's profitable and what's not. So you don't keep investing in unprofitable SKUs. You understand that, hey, this location might be less profitable than that location. Maybe I should shut this one down. You need to have the financials to back up the decisions that you need to make as you grow and scale your business. And then the daily decisions that you have to make. Should I, get more of this product? Should I change suppliers? All that comes from looking at the numbers. And then some people actually go down the path of selling the business. And so if you're going to sell the business, what information do you need to have at the ready so that you can have the conversations with a potential acquirer in a meaningful way? So starting with the income statement. So income statement shows what happens over a period of time. Could be a month, a quarter, a year. It could be something in between. So it's like a movie, right? So you see, here's what's happening throughout time. And you then can say, okay, here's how much we sold. Here's what the cost of all the things that we sold were, right? And the difference being gross profit. So what was the gross profit for those direct sales that we made? And then we have all the overhead, all the selling, general, administrative, your salaries, right? Those are all overhead expenses. And so you subtract those, and that what gets to operating income. And in some cases, that could be similar to what's called EBITDA, earnings before interest, taxes, depreciation, and amortization. Sometimes it's similar. But that operating income minus interest and taxes gets you to net profit, right? So how much do you actually take home at the end of the day? So it's important to understand the movement throughout the income statement and what this looks like, or what does this tell you? If I look at my income statement for the month of January and I compare it to the month of February and I compare it to the month of March, then you start to see trends. And that's where it gets really interesting. You can then do things like, I want to look at January versus January a year ago. Most retailers have seasonal businesses. So let's look at and compare season over season, month over month, year over year, as opposed to comparing January to December, which, in many cases will look vastly different. So the income statement is the business in motion over a period of time. Then we talk about revenue recognition, right? And um, when do you really make a sale? So what actually constitutes profit, right? And the big difference here is most retailers, especially smaller ones, do things on a cash basis. You make a sale, the guy or gal gives you cash or a credit card, and then you book that as revenue right then and there. It's very simple. It's very easy to do. It makes sense in most people's brains. But what the problem with it is that it sometimes, if you have a bigger business and you're selling to many different other types of entities, or you have a lot of vendors and you get bills from them, and maybe you get a bill this month and you pay it next month, or you get a bill next month for stuff that you did or needed the prior month. You need to match the timing of when these bills are come in and paid to when the expense was actually incurred. And this is all going towards an accrual basis of showing your books. Showing your results on an accrual basis means that you're accurately reflecting when the revenues occurred and when the expenses were incurred that support those revenues or just support running of the business. And accrual basis, what's really important is that accrual-based accounting is what lenders, especially, but lenders and investors need to see. So if you go get a line of credit with a bank, or you're going to go raise some capital potentially for an expansion, or maybe you're going to sell the business, your books must be on an accrual basis. And then at some point, after 5 million in revenue, the IRS forces you to do everything on an accrual basis. So you'll see things like, and we put in here a few things to keep an eye on, is like gift cards. Lots of retailers have gift cards. Well, those gift cards, when you have them and when you get them and you put them on the rack or the shelf, it's not revenue right then and there. It's actually a liability because you owe that money, right, to somebody when they're gonna redeem them. So you need to reflect that properly on your balance sheet. You need to have consistent treatment month over month and again, match revenue to the period when you earn it. So you have to do accrual-based accounting. If you're not, you should look to eventually switching over. And this is irrespective of how you do your taxes. Some people will do accrual-based accounting for their books, but pay taxes on a cash basis. And we can talk about that separately. All right. I think this one, Lisa, is you, correct?
Yep.
Oh,
So once we recognize revenue, the next item on your P&L that you're going to always see is your cost of goods sold. And it's all about getting your cost of goods sold right. There's things that you should include in your cost of goods. You've got your purchase price, you've got your inbound freight, the cost that it takes to get your goods to your warehouse or your store, your import duties and tariffs, which we've seen have been a big impact on retail establishments in 2025. Direct labor to produce your final finished good, and your packaging materials for the product. There's things that you shouldn't be including in your cost of goods sold. Things like operating expenses around rent, utilities, marketing, salaries, and shipping outbound to your customers if you are shipping things through like an e-commerce performance platform. When you put all those cogs into your P&L, you get your gross margin at the end. And I think that's on the next slide. So once you take your recognized revenue and you subtract out your cost of goods sold, you get your gross profit. And that's really your first line of defense. Your gross margin and your gross profit, which are interchangeable, one's a percent and one's a dollar sign, kind of tells you what you have left over to handle all your operating expenses and leave you with profit at the end of the day. If your gross margin is too low and it doesn't cover your operating expenses, then you're going to end up with a loss at the end of the day at the bottom line where your EBITDA is. There's another important distinction that retailers sometimes use interchangeably, and they're not interchangeable, or markup and margin. But really what we need to look at is margin. It's your selling price, how much you paid for it, and then what's left over at the end. We wanted to give some benchmarks here around consumer products in the industry and where gross margin should really be targeting, because I'm sure that is a predominant question in your mind as you're thinking through your businesses. Jewelry seems to have the highest gross margin when we're looking at consumer products, whereas you get down to electronics and grocery, and the gross margin there is much lower. That means you've got less left over to spend on your operating expenses. Once we've gotten through your recognized revenue, your cost of goods sold, and your gross margin. The next item on your P&L, as most of you already know, is your operating expenses. There's two different types of operating expenses as you're running your retail businesses. There's fixed costs and variable costs. Fixed costs are exactly what they are. They're fixed. They don't change with sales volume. So things like rent, you pay your rent for your square footage every single month. That doesn't change month over month unless you're leasing a space, let's say like a WeWorks location. You've got salaries. Those are fixed costs. Those don't fluctuate because everybody's getting paid a salary. You've got insurance, whether it's general liability insurance, workers' comp insurance, anything that you need to cover your business. That's a fixed cost as well. You've got software that you're using, let's say, to run your e-commerce platforms, or even that you're using to run your business. And then you also have your utilities. These things are fixed. They don't change based on the volume of revenue that you're doing. There's also variable expenses. Those change with your volume of revenue. Things like hourly employees that are maybe sitting in your warehouses. You know, if you don't ship as much product, you don't incur as much hourly wages for part-time people. Your credit card processing fees, those are variable because those are predicated on the amount of revenue that you're charging on your credit card machines. You've got your shipping costs of shipping your product out to your customers. You've got packaging supplies if you're shipping products out to your customers from your retail stores. And then also maybe sales commissions if your business utilizes sales commissions. But really, at the end of the day, when you're small, your operating expenses tend to be a much larger percent of your revenue because you don't have economies of scale yet. But as you grow, that percentage should be declining because your fixed costs don't grow with sales volume, whereas your variable costs are variable based on your revenue. So ideally, the percent of your operating expenses should go down over time as your business grows and scales. The next line on the P&L, after you've gotten through your operating expenses, is EBITDA, as William mentioned earlier. That's your earnings before your interest, your tax, your depreciation, and your amortization. This is what investors really look at when they're valuing your business. It shows really how your business is operating. It's used by lenders if you're looking to raise capital or you need some extra cash from a lender. Basically, you know, at the end of the day, the good benchmarks here are if you're at around 10% EBITDA to revenue, you're really just getting by. You have enough gross margin or gross profit to cover your operating expenses. So you're really not that profitable at that point in time. If your EBITDA is tracking more around 15 to 20%, you're in a good place. You've got a healthy retail business. You've maximized your cost of goods sold and your gross margin against your operating expenses. So you're not spending more than you really should be. And 20% is really a great benchmark here. If you can achieve 20% EBITDA from your bottom line, that's fantastic. You've done a great job of maximizing your revenue, you're minimizing your costs, and also around your operating expenses. The key to getting all these things right with your financials is really setting up your chart of accounts. Your chart of accounts you can kind of look at as your backbone or your spine of your business. It's really the organization and the filing system of how you record all your financial transactions. Traditionally, when businesses start, they don't maybe put numbering sequences behind their chart of accounts, and they just start naming categories, accounts, and sub-accounts. But it's really important that everything is in a numbering sequence that is around GAAP accounting. Traditionally, revenue accounts start with the number 1, whether it's 100, 1,000, 10,000. Cost of goods sold being the next line item on your P&L, usually run starting with the number 2, whether it's, again, 200, 2,000, 20,000. Operating expenses start with the number 3. And it's just about being consistent. If you start with 10,000, continue on with 20,000, 30,000, et cetera. If you start with 1,000, again, just stay in sequence and stay consistent. The structure matters because the good account structure enables you to see exactly what you're spending, where the money is going, and to be able to compare period to period. The best practice really around the chart of accounts on top of the numbering sequence is to have sub-accounts within your accounts. great example in today's world is, let's say, marketing. Marketing is an operating expense. Within marketing, you can have various types of marketing expense, whether it's spending on Meta or Instagram or email marketing or events. And you want to be able to make business decisions knowing how you're spending your money and recognizing your expenses. So without the level of detail with sub-account structure, it doesn't give you enough flexibility to pivot and make decisions and make smart decisions, whether you want to spend more on Instagram and less on events or vice versa. So really having that level of granularity in your chart of accounts is key to making decisions. Again, here's just another little snapshot of the numbering sequence from your P&L and also the balance sheet. So you've got your assets, your equity, your cost of goods, your liabilities, your revenue, and your operating expenses. Just don't get too carried away with your numbering sequences, because then it becomes a little bit of a bear when especially you get to the point, if you're looking to sell your business, of understanding what's in every single line item.
So the income statement is like a movie, right? So what happened over a period of time? How much did you sell? How much did it cost to, produce those items or get those items in hand? What you spent to operate the business, that's the operating expenses, and then what's left over is the profit and loss. But the income statement is only one part of the picture, right? So here's what happened over a period of time, but it doesn't give you the information that you need in terms of how much cash do you have on hand? Do you have too much inventory? Can you afford to take on more debt? Is the business actually worth anything? These are all on the balance sheet. So the assets and liabilities and shareholders' equity section, those are all balance sheet items. So, the income statement shows a performance over time. Balance sheet shows the financial health of the business at a point in time. So another way to think about it is you have a balance sheet at the beginning, and then you can think of it sort of like a cup of water, right? And the income statement, you're pouring the water in, and after you pour all that water in, you have another point in time. And that's the balance sheet at the end of that period. So that gives you a snapshot beginning, income statement, and then another snapshot balance sheet. So this is how you kind of think about how these interact, how these financial statements interact together. The profits of your income statement, the business, roll over to the balance sheet at the end of every period. So the balance sheet is your business health scorecard, in effect, right? It's a photograph. It shows you at a single point in time. And the way you think about it is you have the total assets of the business. Assets are things like cash. Some retailers might have receivables, but cash, receivables, inventory, right? Those are like the main assets of the business. Sometimes there's prepaid expenses and other things. Then you have the liabilities of the business, what you owe. So if a vendor has given you a bill that you haven't paid yet, if you have payroll like accrued vacation. So you have employees, they've earned some vacation, they haven't used it yet, but you owe them that when they take vacation. Well, that vacation payable is a liability. It's something you owe to somebody else. And you add up, maybe there's payroll liabilities, maybe there's 401k payments you haven't made yet. These are all the liabilities of the business. Credit card, another great example. So you have accounts payable, credit cards, and these other liabilities. You add them all up. That's the total amount that you owe or the total liabilities of the business. And what's left over is the equity, is the value of the business that's left over. If you literally liquidated the business and you said, okay, I have all these assets, I'm going to pay off all these amounts that I owe. What would I have left over? That's the book value, if you will, of the business or the equity. It's not the same as what is this business worth if I sold it. Different completely. This is just literally if I liquidated the business, how much would I end up with in my hand? So you need to focus on both the income statement, which shows, how much profit did we make over a period of time, and the balance sheet, which shows what's the value of the business in terms of book value. What do I owe? What do I have at any one point in time, which is the health of the business. These two things go together. So the balance sheet structure, we sort of talked about some of this, but on the asset side, what you own, right? So cash, inventory, prepaids, AR, accounts receivable. And then those are current assets, right? So a current asset is something that could convert to cash or will convert to cash within a period of 12 months. Anything that's longer term, like your fixtures in the stores, right? Or maybe you have a forklift, right? Or maybe you've improved the location. You've put money into putting things on the wall and carpeting and whatever, lighting. Those are all long-term assets. You've put money into, you've invested in the business, real money, and you have to book that on your balance sheet. So you show, here's how much I've invested in the business. Over time, those assets, those long-term assets, will decrease in value. That forklift that you paid $100,000 for, it will be worth less, each year. It depreciates, it loses value. So you have to track that as well. So that 10-year-old forklift might only be worth $5,000, right? So that's part of what you need to track. On the liability side, we have current liabilities, what's due to somebody within 12 months, accounts payable, credit cards, etc. Current portion of a loan, let's say you have a line of credit and you're making payments on that, or a term loan, you're making payments on that. So anything that's due within the next 12 months, it's current. Anything that's due beyond 12 months is long term. So maybe you have a 5-year bank loan, right? And the first year is current, 4 years beyond that is long term. Maybe you finance some equipment or you have other long-term debt. And then what's left is the investment you've made in the business, that's what you've contributed to the business, and retained earnings. Retained earnings is simply the total profits of the business added up over time. So since its inception, the business has earned this pile of money. And that's what goes into the equity section. All right. So current assets we talked about, but really what you're targeting is how much cash should I have on hand? This is a question we get a lot, not just from retail business owners, but just in general, business owners always want to understand how much cash should I have on hand. So, a good rule of thumb is to have at least 2 to 3 months. Think about it like, if you're just as an individual, the rule of thumb is a little bit longer because you need to have, rainy day funds in case your roof leaks. Typically you hear about 6 months personally, but from a business that's ongoing business that's been around for a while and you have a good track record, 2 to 3 months minimum is kind of what you should be thinking about. So if you have $50,000 of operating expenses, so sales, marketing, general administrative, your salaries that you pay workers, etc., not cost of goods sold, none of that's included here, because that's dependent upon sales. It's just what does it take to keep the lights on? So in this case, let's say it's 50,000 a month. You need to have about 100 or 150,000 in cash on hand. Again, that's sort of in case or to enable you to ride out the ups and downs of what happens on a daily, weekly, monthly basis for most businesses. When you think about cash flow and liquidity, this is something that I'm sure all of you think about a lot, is what do I do if I have to pay my suppliers well in advance of when I sell the products, right? So this is where there's a really important to understand cash forecasting and to spend a little bit of time putting in a spreadsheet. Okay, here's how much I'm selling. Here's how much I need to buy in advance. Here's when I think I'm going to sell that based upon historical metrics and historical data. Here's how long it takes to convert to cash, right? So that cash conversion cycle, and it might take 60 days, it might take 90 days. Some people have even longer, right? If you're in fashion, might take you 6 months, right? By the time you order and get the goods in from overseas, and then they get on the shelves, et cetera, et cetera. So you need to think about that cash conversion cycle. You need to think about your supply chain and what terms you have with your suppliers, and then put that into a forecast model so that you can accurately predict, do I have enough cash to ride out the seasonality of this business, or do I need to get a line of credit or some other way of bridging that gap? Um, Lisa, you jump in whenever you need to, but in most retail businesses, there's not a lot of AR, but some cases that you might have it, right? So in some cases, you might invoice a customer and they pay you at a later period of time. That's fine. It happens in many B2B, regular B2B businesses. It happens all the time. So when you do that, you need to make sure that you have properly your contract states, here are the payment terms. Here's, if there's a consignment arrangement, here's the split. Here's how much we're going to get when the item is actually sold. Sometimes you want to make sure that you have a collection process already put in place in advance so that you do what you can to get these receivables in as quickly as possible. Convert that invoice to cash, and you'd have to do everything you can to manage that AR, so that you're really on top of how long is it going to take you. Because what happens is they'll stretch, say, oh, I'll pay you in 30 days, and ends up being 45 or 60, and you're in effect financing their business. And so you're not getting paid to do that unless you put in the contract, hey, if you don't pay me in 30 days, I'm going to start charging you interest. So things like that need to be on top of your mind. Again, most retailers are going to have minimal AR balances. If you get anything that's over 60 days, that's a flag. And then make sure that your customers are paying on time. And if they're not, why not? And where's the breakdown happening? Is there something going on in their business, or not? Or are they just stretching you? If you have to offer terms, think about net 15 rather than net 30, or you could do 2 net 30 and give a discount, 2% discount if they pay within 5 days or something like that. But yes, cash on delivery is really what you're trying to achieve. All right,
One
I'm
of
going to hand this off.
Yeah. The next item that we actually really focus on from a balance sheet perspective, and even from a cash perspective, is your inventory. It's retail business's biggest asset and also the biggest risk. You need the inventory to make your sales, as we all know, but the inventory also ties up cash. There's a lot of carrying costs around it, right? We've got the capital that we need to purchase the inventory, could be money used, spent elsewhere. We've got storage costs, warehousing, shelf space, and all those things associated with storage, whether it's utilities, insurance that you're paying your warehouse to store your goods. Depreciation, obviously, inventory loses value over time. You've got shrinkage. When it sits in a warehouse, you never know if there's theft or damage or obsolescence to that inventory. So the aging of your inventory becomes a key factor in determining it being a risk or not. And then there's your opportunity cost. You could be missing better inventory buys, but your cash is tied up in inventory that's sitting around and sitting on your shelves. So really, the faster you turn your inventory, that improves your cash flow and gives you better visibility and runway to spend on other things to promote your business and move your business forward from a strategic perspective. It is the silent profit killer, right? So when we look at dead stock, dead stock is considered something that isn't selling. If it's sitting on your shelves and it's aged out, that means it's probably not going to sell for the same price of what you were initially thinking it was going to sell for. It's taking up space, it's tying up your cash. And like I just mentioned, you're going to probably end up having to mark it down or write it off because you can't sell it. How does this end up happening? If you're not demand planning or ordering for a trend or ordering too much for a trend that didn't really pan out, then you get stuck sitting on the inventory and then you have to mark it down. Or you're buying too deep. And it's kind of hard to tell right off the bat if you're ordering too deep without having a consistent planning model to determine what SKUs are selling and what SKUs are not. But then you've also got sales forecasting. And if your sales forecasting doesn't get fine-tuned on a regular basis, even if it's a monthly basis, then you potentially end up buying more inventory than what you really need. And then if you're not cutting your losses on underperforming SKUs and thinking about that strategy of how to sell them, mark down or writing them off, then you are still, again, tying up cash with dead SKUs that are really not providing any added benefit to the business. Here's a little bit of an example, though. Sorry, I just got obstructed by the comment. Sorry. If you paid for 8 months for 8 months ago for inventory, right? The cash is gone. You've already spent it. You had payment terms on your payable, you paid it, but you're taking up valuable shelf space with the inventory. So if you haven't sold it and it's still sitting there, it's really that opportunity cost of cash that you really have not capitalized on. So really looking at run rates by categories, looking at your markdown cadence, and making sure that you're reserving for these things is really important to keep your inventory tight and keep your inventory profitable.
Hey, Lisa, I have a quick question. Hopefully it's quick. If along the way you know that you have dead stock, do you make an adjustment on your balance sheet along the way, or do you wait till you clear it out?
Technically, I make the adjustment on the balance sheet right then and there to reserve for, let's say, slow-moving SKUs. So this way, when you finally do sell it off, or you do sell it at an off price, you're not getting hit to your P&L, later in the game. You're kind of accruing for it when you actually know that it's not going to sell off. So on the original point in the slides around accrual accounting, that's the best way to do that. Fixed assets. That's another item that sits on your balance sheet, as we all know. Fixed assets are long-term assets. They are used in the business, but they don't convert to cash quickly. So when we're looking at liquidity, this is not something that necessarily comes into that calculation. We've got furniture and fixtures, whether it's computers or office desks or all those things associated with putting an office in place. Your POS system, your computers that you give to your employees, vehicles, leasehold improvements. These are all long-term items that don't necessarily convert to cash quickly. Fixed assets, they wear out, they become obsolete over time, and depreciation spreads the cost of the asset over time. So these are just two other items that sit on the balance sheet that are just part of doing business.
We covered a lot of this already.
Yeah, we did. This one's, I think, back over to you.
Yeah. So current liabilities, we talked about long-term liabilities. Again, anything that's due beyond 12 months from now. So term loans, SBA loans, equipment financing, etc. So when you go get a new loan, right? If you want to borrow money today, you need to know how much debt you already are carrying. How much do you owe as of right this moment in time? And maybe it's just, your credit cards and your AP, your vendors, but your bank is going to ask, or the prospective bank is going to ask, well, how much do you owe and what are the terms, etc. So you need to understand how much do you owe and to whom, including your equipment leases. So make sure that you have a detailed ledger for any equipment, furniture, etc., that you've paid over time. And what's left, again, is the equity in the business, assets minus liabilities. So it's what's left after you pay off all the debts. Again, if you liquidated all your assets and you paid off all your liabilities, how much would be left over? So, in some cases, you're looking at a positive, right? Ideally, in some cases, you might not be. You might have a negative net worth in the business, but you're making investments and you're going to turn things around, and you know how that's going to happen. But obviously, it's a red flag if it is negative. That means that technically you are insolvent. But there are cases, and we've seen many cases of companies that have a negative equity or negative net worth that again have turned things around because they invested heavily in the business. They borrowed heavily on the business because they knew something was coming that was going to change things, or they were going to make changes in the business. We don't recommend that you operate at any length in time in the negative, but in short time frames, sometimes it is necessary. So what can you do if you have negative equity? This just goes into the situation. It's really hard to get financing. It's hard to sell the business. It's hard to raise capital. So you need to, there's several fixes. You can put more money from your savings, inject new capital into the business to prop up the equity side of the balance sheet. So you're just literally putting cash into the business. You turn the business around by making it profitable. So whatever's causing that or caused that loss, maybe something in the outside of the business changed, tariffs now are gone, whatever it might be. But if you can get it back to profitability, that will help, get rid of negative equity, restructuring your debt, right? So maybe there's a lender who's been a lender for a long time, and you say to them, hey, I can't afford this, but if you give me different terms, or maybe you go to your savings and you say, I'm going to pay you off all in full today, or not in full. I'm going to pay this off, but I'm going to settle it out at 50 cents on the dollar, something like that. There's ways of restructuring the balance sheet so that you can then show the bank that you have positive equity in the business. And then again, rebuilding over time is just becoming profitable, and generating that additional income and putting that into retained earnings over and over time.
Working capital, something that we all are fond of understanding, because working capital measures your ability to pay your short-term obligations. It's your current assets minus your current liabilities. So if your current assets are, let's say, 300,000 and your liabilities are 150, you've got working capital of 150,000. What does this mean? You really got $150,000 to take care of your day-to-day operations. So really the key target here is your working capital should really be, your assets should be about 1.5 to 2 times your liabilities to give you enough runway in your working capital.
Okay.
And here's just a little bit more details around that example. Current assets are 350, and these are the components that make up current assets, right? You've got cash, you've got inventory, you've got prepaid expenses, you've got your current liabilities, and then you end up with a working capital of 200,000. But however, we all know that inventory is not really cash sitting around. It's tied up in inventory. Prepaid expenses are prepaid. So really the cash there is $50,000. But part 2 of our seminar is about diving into other ratios that'll give you a better understanding of liquidity, specifically the quick ratio, where we don't include things like inventory, and that gives you a better handle on the cash on hand to be able to sustain the business. What does all this mean for your business? Revenue recognition. It's all about recognizing revenue correctly from an accrual accounting perspective right at the beginning. You recognize revenue when technically transfer of goods, the goods transfer possession from you to the customer. Consistency. Consistency is really key. If you're not consistent month to month, it makes it very difficult to make the strategic decisions for your business and move the business forward, because you're constantly trying to understand what happened last month versus this month. Document your policies, and again, be consistent on the policies that you're following, whether it's around how your what your shipping policies are, what your payment policies are, and sticking to them. Really operating more around the rules rather than exceptions to the rules every day. Clean books, clean books, clean books. It's really the name of the game, because that's the only way to get bank financing, for example. Scale your business with confidence and bring on investors if need be.
And there's a really good point here, because we see this all the time, is we get brought in and people say, oh, my books are clean, and they really, really aren't. And it costs, there's a lot of money to go back in time to detangle what happened, and memories are short. So we ask the owner, okay, well, why did you pay this person, $25 for this, or $100,000 for that, whatever it might be, and maybe the records weren't kept right, and we are forced to try to come up with a story that fits what we think happened, and it just takes a lot of time, and therefore it's very expensive. So it's really, really important to keep the books clean, as Lisa said, from the get-go, and because we just seen it time and time again be a big problem.
I think one
So
other thing I'd like to
go for
point
it.
out from what Bill just said also is that your chart of accounts is really your roadmap and your the way you run your business. If you have a bookkeeper that sets up your chart of accounts that doesn't have any accounting background, odds are you're going to probably need to rework that or revamp it in some way, because you want it to be set up for, you want to be set up for success and be able to run your business.
100%. So we went through the income statement, looked at gross margins and where you should be targeting, talked about why EBITDA is important. We just talked about, and Lisa did a good summary of the chart of accounts. And then on the balance sheet side, what's current assets, current liabilities, net worth, et cetera, working capital as your cushion. So these are the basics, right? This is what you need to understand in terms of, financial literacy. And as Lisa alluded to, on the next seminar we do in a couple of weeks, we're going to dive into the KPIs, the key performance indicators, the metrics, things like inventory turns and quick ratios, so that you can get a better idea of what are the knobs and dials that you need to manage the business better, right? But we had to start with some of this basics before we jumped into a little bit more of the advanced work. So for those of you joining next time, it'd be great if you could spend some time looking at and pulling your current financial statements. If you don't have them, your bookkeeper can give them to you. Check your inventory and see what's going on there, and then calculate some of the numbers that we talked about today, and write down 3 questions and bring them to the next webinar. And we'll answer them. If we don't have time to get to all the questions, we'll have our contact information, so you'll be able to get a hold of us, and we could have one-on-one conversations with anybody on this call. So part 2, as I mentioned, we're going to talk about financial ratios, inventory metrics, cash flow. Going to dive deeper into cash flow management, and look at some performance benchmarks against the industry. So we really want to give you some ideas as to what makes a really successful retailer excel and pull away from the crowd, as opposed to the ones that are, as we wrote here, merely surviving. And that's what's really important at the end of the day. All right, Nico, I'm going to hand the mic back to you.
Absolutely. Thank you so much. That was a lot of information. As I mentioned, this is being recorded for anyone that feels a little overwhelmed by some of the numbers here. We are going to send out a recording. We mentioned part 2, so we have had a lot of registrations. If you haven't registered yet, I dropped a link to the chat to register for part 2, as well as a couple of links specifically tied to inventory management and forecasting, which is what we do here at Management One. I'm also right there in chat. I put a link to your website, William, just in case people have other questions, looking for information between now and session 2 on November 13th. Okay, let's get to the first question. We have one by, oh, they did want to share their name. Anonymous attendee. He or she asks, very new business owner here. One area I feel I'm missing is knowing what exactly I need to be doing finance-wise on a daily, weekly, monthly level to be prepared for my bookkeeper.
All right, Lisa, you want to try that one?
Yeah. So thanks for the question. Daily, weekly, and monthly. I'm going to work backwards from monthly. Monthly is about closing your books timely, whether it's 2 days after the month ends or 5 days after the month ends. It's about, again, consistency. Please, making sure that you're closing your books on, let's say, the 5th day of the following month. So this way you can see how your business performed from the prior month against potentially a budget that you may have in place. That gives you the opportunity to be able to shift things that you're doing in the following month, whether it's changing your expenses or trying to push more inventory out the door or purchasing new inventory. But it's about intertwining all of those things and making decisions timely. So closing the books in a timely fashion every single month with that consistency is really important. Daily.
So Lisa, so hang on one second. So this, I think the question is, what do I need to do to prepare if I have a bookkeeper? So what do I need to
Yep.
do to give the
Oh,
bookkeeper?
sorry, I missed that. Really just your daily activity. If your bookkeeper has access to your POS system or your financial system, they should be able to see how the business is performing and have all that information, whether it's AP, AR, or your sales data, and feed that into your P&L.
And
Excellent.
then if there's any change in inventory value, like if they see something that's really not moving month by month by month, they need to alert the bookkeeper
And
because
also
they have
your
to,
bank statements. Yeah, and your bank
right?
statements also. So that's critical also because that tells the story of how much cash is sitting in the bank account.
Yep.
So we had a related question. I'll just jump to that one because it is related to this one here. Jeff was asking, what's the ideal frequency for reviewing our financial statements? Is it monthly, quarterly, or is weekly too much?
I don't think it's necessarily a weekly thing because your vendors have payment terms normally net 30 days. So if you're going to look at it on a weekly basis, that's not going to give you the accurate picture. Monthly is a great cadence, and it should be something that is followed rigorously, that follows a month-end close process from closing your books, making sure all your AP is posted, making sure that you've recognized all the revenue from everything that you've either sold or shipped out of your store, and looking at a P&L from that perspective and a balance sheet.
I would definitely, there are some businesses that have weekly dashboards, but that's more activity based. So what was our total volume this past week? What was our average order value? How much cash is in the bank, right? So there's some activity level reporting that you could do in a dashboard, typically out of a POS system or something like that. That could be very beneficial to managing the business intra-month. But Lisa's absolutely right. You don't need financials on a weekly basis.
Excellent. Next one here. We've got Lisa, different Lisa, is asking, what's a reasonable time frame to clear dead stock before it starts dragging down our cash flow, and how aggressive should markdowns be? Oh, I wish Paul Erickson was on this call. So Paul has a whole presentation on this, but Lisa, I think that would fall to you.
Yeah, I mean, traditionally, looking at an aged inventory report as part of your month-end close gives you that visibility. I think once you hit, anywhere 30 to 60 days past as aged inventory is really important to start focusing in on that, especially if it's a seasonal item or a seasonal business like apparel, right? You don't want to be selling summer goods in the winter. So it's about understanding the seasonality of the goods and the seasonality of the SKUs and determining what's the right cadence for the business. Normally markdowns go anywhere from 5% to 20%. But again, that depends on the type of business, whether it's jewelry or electronics or anything, but the seasonality does come into play. So it's not really a one size fits all answer.
Definitely a good question to ask one of our retail experts here at Management One. Speaking of which, Robert is asking a question. For retail fashion businesses, please explain the advantages, if any, of when the fiscal year should start. For example, January or July.
Traditionally, I've seen calendar year and fiscal year coincide, but when you get into the apparel world and fashion, there's the other calendar that everybody operates to. It's the 4-5-4, I believe it is. So it all depends on, again, what's making it more comfortable for you to be able to run your business. I've done it both ways in retail establishments.
The one thing I could say, separate and distinct from just a retail business is going on a different fiscal year, like a June 30th fiscal year or even March, is that your tax accountant or auditor, if you're bigger, but your tax accountant will be a lot less busy because they're not dealing with all the December 31st work, right? So, come February, March, April, everyone's super busy for the prior year end. But in June, July, August, they're not. So you get much more attention if you have a June 30th fiscal year, just as an aside.
Thank you. Let's see. Karen is asking, what's the most common mistake that small retailers make that gets them in financial trouble? And what's the average lifespan of a small store open today, in your opinion?
Retail is a tricky subject, right? After COVID, we've seen a lot of retail establishments come back full force and being extremely successful. So it's really, again, not a one size fits all. I think that it depends on the industry, the location, the demographics, and multiple things. I think one of the biggest mistakes is hiring too many people, thinking that your business is going to grow, and then trying to understand and have to unfortunately lay off people. So it's about that right sizing of your business model that strategically moves you forward and being very strategic in those moves, whether it's hiring new people, getting a bigger store, taking on a second location. And William had touched on it briefly, but that four-wall accounting is so critical in retail because you need to make sure that each location is profitable and bringing enough bottom line to support opening up a new location.
Yeah, I would second that. And it's really cash flow management. I mean, just like again, any other small business, cash is king. So if you don't properly forecast cash, and this is where Lisa's talking about hiring ahead of revenues, is using more cash than is coming in. So that cash forecasting and having that fiscal discipline to stick to a budget, and if there's any variance, make sure you quickly adjust so that you're not spending cash way in advance of when those revenues show up. So that cash forecasting is critical.
Thank you. A couple more here, just to be mindful of time. Robert is asking, where should retail markdowns show up as depreciation on P&L or on the balance sheet?
They show up, you accrue for it on the balance sheet, and then as you sell the product off, then it recognizes over to the P&L.
Excellent. Final question. Oh, they didn't want to share their name with us. Anonymous attendee is asking, if you plan on selling a fashion retail business, when is the best time of year to sell?
I think, again, it's not a one size fits all answer.
Yep.
It depends on profitability. It depends on what your net income is and where your trajectory is for that business. It's really not a seasonal answer. It's based on the performance of the business.
You definitely don't want to go to market, like go start to try to sell your business in October. Just because November, December, everyone's going to be super busy and you're not going to get any eyeballs. So that's the worst time of year to try to sell your business.
Good advice. Oh, one last one here. About gift cards. So I know you had a slide specifically on this, William. Marcus is asking, you said gift card revenue is a liability until it's redeemed. So how do we recognize revenue from expired or unredeemed gift cards?
I'll let Lisa answer that one.
I don't think you can't recognize revenue from the expired gift cards. I'd like to take that as a follow-up if that's okay, because
Yeah,
there's
absolutely.
many conflicting and merging opinions on the rules and the gap accounting of it. That it's a little murky of a question to answer with a succinct answer right now.
Perfect. Thank you so much to both of our panelists here today, and thanks for all of the questions from the audience, spirited audience today, which we like to see. As we mentioned before, this was just part one of our two-part series. So on November 13th, at the exact same time, we are going to sync back up with William and Lisa and dive into some deeper topics on a couple of the knobs and dials that retailers have at their disposal. So I just want to give a great thank you to William and Lisa for all the information today. As I mentioned before, there are some links in the chat if you want to reach out to CEO's Right Hand or Management One. And we will be sending out a recording along with the slide presentation shortly. Thank you so much.
Thank you.
Thank you.